Welcome to the HC Commodities podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Today we are discussing signal versus noise, how to understand and how to navigate the new Trump administration and its impact on domestic and global markets, particularly around energy and commodities. Our guest is Nick Kumleben. Nick is the Energy and Commodities Director at Greenmantle, the advisory firm founded by Niall Ferguson, focused on geopolitical and macroeconomics, taking a deep understanding of history to learn the lessons that can be applied to today's world. They advise funds, traders, and governments. We split this episode into two parts. Part one will be covering the broader theme of signal versus noise, how to understand the Trump administration, the right historical analogies to use, what this means for economic policy, and the starts of energy policy. In part two, we'll discuss how those policies translate into prices and potential inflation. We'll tackle the metals markets and critical minerals in detail, talk about economic security and associated government intervention, and then what this means for the commodity traders, what this means for the global markets, and some of the opportunities and challenges that may arise. As always, you can really support the show by leaving us a positive review on the platform you're listening on, and I hope you enjoy the episode. Nick, welcome to the show.
Thank you, Paul. Long-time listener, so pleasure to be participating.
Excellent. Well, I'm looking forward to today's conversation. Firstly, we're recording April 8th. I think we should just put that on the record, just because lots can change between this being recorded and it coming out, but some things won't, and that's what we're talking today, which is really how to pass the signal and the noise when it comes to the politics, the policies, the volatility created by that, particularly from the US administration, and how that impacts the broader commodities world. Before we sort of start with that, I think it's going to be useful for all of us to understand a bit more about you and how you're coming by the insight you're about to relate.
Thanks, Paul. Happy to. So I'm the Energy and Commodities Director at Greenmantle, which is a geopolitical and macro advisory firm. Greenmantle was originally founded by the historian Niall Ferguson shortly after the financial crisis on the central insight that we could leverage the lessons of history to advise investors and policymakers. So we apply historical frameworks to today's problems and marry those historical frameworks with on-the-ground intel from policymakers, from investors, from businesses, helping our clients to understand how the big shifts in global policy and macroeconomics are changing their businesses. And what we have in front of us over the past few weeks and over the broader term of the current Trump administration is a great example of these kind of shifts that are best understood through that long view.
We should say you're based in DC, and these are conversations you're having daily with policymakers, legislators, but also the broader economic community as well. So, this is not just done in the classroom. Okay, so let's start with that signal and noise, the key premise of this, how to sort between the two. But, can you just frame up the conversation we're about to have? Why are we talking a lot about noise?
Well, I think we're talking a lot about noise because it's quite easy to fixate on truth socials and tweets at all hours. A great example of the noise is the fake news tweet from earlier this week that sent markets up quite violently, only for the White House to go and have to debunk it on TV and give a clearer perspective on what they're doing. And both the scale of the changes the Trump administration is making to the global trading system and the way in which they're communicating that gives you a lot of noise. You could focus on what Trump's tweeting and you could think, we're going to annex Canada and Greenland and tariffs are permanent. Or you could find the signal. A good example of this is in how investors and businesses tried to analyze the administration in the period between the November election and Trump actually taking office in January. There are multiple ways to do that. You could read all 922 pages of Project 2025. That would probably give you a lot of noise. Or you could watch the 26 videos on Trump's campaign website. laying out his views on everything from energy independence to homeless veterans. And the key lesson of the Trump administration, which was not as clear in his first term, was that Trump himself is the signal. And his advisors and his cabinet secretaries are there to provide backing and credibility to Trump himself. But he is the central figure in this administration and has a degree of power that no executive has had in the United States for quite a long time. The difference there really is that you don't have the people around Trump who are saying no to him in the way you did in the first term. There's no Robert Lighthizer, who's been a clear voice on trade since the 1980s. There's no Stephen Mnuchin stepping in and providing the interests of business in a very clear way in the room. There aren't the generals who provide a degree of institutional stability to the first term. What you have now is an administration built around Trump's worldview that was expecting to win the election and staffed with people who are aligned with the president in a way that simply wasn't true in 2016. What that means from a policy perspective is that you have to find the issues on which Trump has been consistent, both in his campaigns and throughout his life. Take trade as an example, and you can go back throughout Trump's career before politics and see a consistent through line in his views on trade. There's an excellent interview with Playboy magazine from 1990, and I think the quote that best summarizes Trump's view on trade is, "I think our country needs more egos. It's being ripped off so badly by our so-called allies, i.e. Japan, West Germany, Saudi Arabia, South Korea, etc." When you look at Trump that way as a fairly consistent populist voice on trade, which echoes a lot of some of the past Republican administrations, it's a bit easier to see that a significant reshaping of the global trading system was coming, and that unlike in Trump's first term, it's not just focused on China, and it's not just focused on sanctions on American adversaries, on export controls, on key technologies. It's about the US trade balance. It's about goods deficits. It's about reshoring manufacturing. And it's about a very specific view of what American economic preeminence should look like, one that brings the threat of trade action, not just on adversaries, but also on America's allies.
You know, there's so much there, and you're right about Trump has actually been very consistent. And I have this sort of theory that actually it stems back to his father's milieu from the 1930s, when you had sort of, Make America Great Again was actually a remnant of sort of the Woodrow administration. You had the implementation of tariffs and so forth. So, there's sort of that historical context there that he got from his father, I guess. But there is that consistency. Before we kind of move on to the history of this, or the right historical analogy, just a couple of questions and challenges. First, would be, he certainly has around him a team that is more pliant, so to speak. They themselves, though, are causing some noise. In the current market turmoil, there's a piece in the New York Times today. Again, this is a very sort of date-stamped episode about Howard Lutnick's confusing messaging around this. There's sort of still this belief that you've got, Bessent doesn't really believe that in tariff, all this piece as well. How tamed are the cabinet to these policies, do you think, or will we see some splits there? And then secondly, as the presidency assumes more power, most of these tariffs are enacted by executive order. Are we going to start seeing, in some ways we might be already seeing, Congress take back some power? Just to tackle those two pieces.
Certainly. So as we look at the cabinet members in themselves are very impressive people, but many of them from a background that you wouldn't call explicitly political, with the exception of some of the people who've moved from Congress to state. So if you look at Scott Bessent at Treasury, he's obviously a very successful and very thoughtful global macro investor by profession. Lutnick ran Cantor Fitzgerald, but there isn't really a strong political overlay of a lot of these cabinet secretaries. And I think what we've seen is that the selection mechanism for high-level appointees is primarily their relationship with President Trump, both in terms of length and in terms of loyalty. Lutnick's a good example of that. Obviously, they're well aligned ideologically, but there's a personal loyalty there that stretches back a long time. If you look at who's taking the really challenging issues, Steve Witkoff's a fantastic example. Witkoff obviously doesn't come from a traditional political background. He's a real estate investor. But he is someone who the president can have confidence in to agree with him and to execute his strategy. In many ways, that's some of the key lessons for Trump of his first term are if you take people from traditional DC or from the military and you put them in office, your efforts to drain the swamp will be somewhat compromised. And I think we can see that in everyone from RFK Jr. to Pete Hegseth to the special envoys for these thorny geopolitical issues, who really don't come from a conventional background. You put that together with Doge and the scale of the layoffs, firings, and resignations across the government, and what you have is by far the most powerful executive that you've had probably since the days of Richard Nixon and the post-Watergate attempts to reform executive power.
Just briefly, because we've got a lot to get to, I guess, will we see, is the reaction to this potentially, and again, this creates more noise as well, it's hard to divine, how this will play out. Are we seeing Republicans in Congress, starting to coalesce around fighting something, particularly tariffs is where we're seeing? Are we seeing, could this empower Congress once again, or are we going to see quite a muted, tame Congress, at least for the next 2 years?
What's interesting about the reaction to tariffs is it's not just the iconoclasts in Congress who are pushing back. It's not just Mitch McConnell who's retiring, or Lisa Murkowski, or Susan Collins, or Rand Paul, who's always marched to the beat of his own drum. It's people like Ted Cruz coming out and saying, to paraphrase, hang on, we haven't thought this through, and this may damage our standing internationally. I don't think we've seen enough firm pushback from Republicans to see Congress really take to form a significant block in the road. You obviously need a supermajority to roll back any of the president's trade measures. And given how strong Trump is, given the threat of primary challenges, given the threat of having Elon Musk fund a primary challenge against you, I think especially in the House, that gets quite difficult, because it would be a very brave Republican who came out against the president and ahead of the White House and said, I disagree with President Trump's central economic policy. And in fairness to the executive, they've been relatively clear about what they want to do, and they can claim a mandate for it.
Yeah. I mean, that's the point, isn't it? Yeah.
The tariff man, and he won the election quite comfortably.
Yeah, it was all there. This comes back to your initial point, right, which is listen to Trump. You can sort of work your way down Project 2025. They're doing that. He's been very clear. The mandate obviously isn't as big as they are claiming, given the actual election results, but they've been very clear. Okay, so coming back to this theme of signal versus noise, and I guess the founding predicate of Greenmantle is that there is historical analogies that we can learn from. What is the right historical analogy to be thinking about today, and thus thinking and planning on decisions that every board and executive is facing right now?
Well, we've already discussed Nixon and the post-Watergate concentration of power within the legislature relative to the executive. Trump wants to roll that back. In some ways, if we think about a president who's trying to reshape the American economy through executive orders, the right analogy is FDR and the New Deal, although obviously with the sign reverse, Trump wants to shrink government and increase tariffs. FDR reduced tariffs and increased the role of government. But we think the best historical analogy is actually William McKinley, both in his career in Congress and as the president. And Trump's mentioned this. If you look at Trump's interview to Bloomberg last summer, his take on McKinley was that he made this country so rich and all he did was tariffs. McKinley, one election on a pro-tariff platform, pushed through tariffs both as a congressman and as president. He raised the effective tariff rate from 41 to 52% in 1890 to protect domestic industry. And then while he was president, you had the Dingley tariffs, which raised the average tariff rate again and stayed through almost the start of World War One. What you also have some echoes in foreign policy. McKinley annexed Hawaii, which eventually became the 50th state. Trump would like to make Canada the 51st. McKinley set the Panama Canal in motion, and Trump would like to take it back. You can see this expansionist, tariff-focused policy throughout Trump's administration, and we think that's the best analogy. There's a through line here, really, of Republicans in the late 19th century and first half of the 20th century as this protectionist, pro-tariff, pro-reindustrialization party. But it's also worth looking at these historic analogies. What were the differences? And one difference is that the US was already structurally increasing its global manufacturing share in the back half of the 19th century, whereas today it's obviously been shrinking for decades in a fairly straight line. If you look at, say, the share of manufacturing employment in America, you're very hard pressed to find on a 4-decade chart to see the effect of the accession of China to the WTO or the start of NAFTA, whereas in the late 19th century, US share of global manufacturing exports went from 4% in 1890 to 18% in 1929, despite very aggressive tariffs. So in a period of tariff rates rising, the US actually succeeded in pushing more of its exports out to its global partners. And the situation today is much, much more difficult for those who'd like to see an American manufacturing renaissance, because you have very high wage costs by global standards, you have permitting issues, you have reciprocal tariffs and non-trade barriers in other countries, and there's an energy access question as well in a world where anyone with power is trying to find a data center to sell it to rather than a clothing factory, an auto factory, or a steel plant.
Yeah, so I'm sort of staying with the McKinley analogy, which for him didn't end up too well. What are the lessons there? Because, some tariffs he rolled back quite early on, as assuming there was ineffective, like, I think, galvanized tin cans and so forth. But, what can we see from his presidency, from his economic policy, that helps us divine a little bit what we're seeing today and potentially over the next 3 years?
I think the simple answer is that a very surface level analysis of McKinley would imply that these tariffs worked. As I said, the share of global manufacturing accelerated significantly in the post-McKinley era. There are structural barriers to that today. So perhaps the great lesson of McKinley is that tariffs are all well and good when you have structural advantages in producing manufactured goods at a lower cost than your competitors. That might apply to Vietnam today, that might apply to China today, but it certainly doesn't apply to the United States. Part of the difficulty in assessing McKinley as a historical figure, of course, is that he was assassinated during his time in office. I think the lesson from McKinley is really that tariffs are a problem if you don't have cost advantages. They struggle to make up for cost advantages, as we saw in some of these goods that you mentioned where the tariffs were rolled back. But the US had such tailwinds at its back that it was able to raise revenue and continue to grow manufacturing. I think we'd be very surprised if that happens this time around.
Yeah. Do we have any sense of where President Trump is getting his love for tariffs from? I mentioned sort of his father and that kind of worldview. Is this a broad sort of policy that's been, doing the rounds of DC for some period of time, or is this kind of like sui generis from Trump's own worldview, and in that sense a huge anomaly? Like, what is there broader support behind this? I mean, it just seems sort of in today's sort of global free trade order, especially one where the US is, as a services exporter, not a product exporter, and has benefited enormously from very cheap goods. Okay, yes, absolutely, globalization has had negative impacts as well. But again, at McKinley's time, there was a backdrop of tariffs. These things were being used all the time. That was the sort of mercantilism world order at the time. It's so anomalous today. I'm just trying to. Do we have any greater sense of where this came from, and whether, if there were no President Trump, this certainly, to my view, wouldn't be a line that the Republican Party was going down.
That's right. And I think it speaks to the success of Trump's one-man takeover of the Republican Party, that it's become, if not consensus, the political direction in which Republicans are moving. I think if one looks at, say, the differences between a figure like Peter Navarro, who's really the key trade whisperer for Trump, who supports this very, very hawkish trade policy, and even compare him to a figure like Robert Lighthizer, who has pushed back against unfair trade practices in China and elsewhere for the majority of his career, but wouldn't likely support this kind of universal aggressive tariff that doesn't take into account services. Trump is out on a limb relative to both Republican orthodoxy, and I'd place quite a high wager that he's out of step with the personal views of the majority of the Republican congressional delegation, and yet his power is such that they're very likely going to go along with it. What this is interesting, though, from a historical perspective, is how Trump frames the economy. He isn't particularly interested in services exports, and the services economy, if you look at how the tariffs were calculated, right, it was really a question of the trade deficit in goods. And so it's this view of the world in which services are somewhat of a second-class citizen in terms of thinking through a country's economic preeminence in the world, partly because they're intangible, difficult to quantify, but also I think it speaks to a distributional question in terms of who in America we valorize and who we valorize from an economic policy perspective. Trump wants to bring back factories with a focus on the lower end of the labor market, and is much less worried about the knowledge economy, about high value added exports. It's really a response to the China shock, as David Autor put it in the famous paper. So it's what Trump is trying to do is bring back these stable middle-class manufacturing jobs, and I don't think he seems particularly worried about what that does to services and the exports that have become the backbone of America's trade balance. A good example of this is if you look at the relationship between the United States and the European Union. To strike a deal, President Trump wants Europe to buy $350 billion in American energy exports. The US has about a $350 goods trade deficit with the EU. EU gas demand is, call it 100 billion US. 80% of that's imported, and oil drillers are unlikely to create a glut in the US to be exported at today's break-evens. But Trump doesn't really care about that. He is focused on the flow of goods and physical commodities in a way that only really accounts for half the picture.
Yeah, it doesn't include sort of McKinsey PowerPoints and, JP Morgan investor decks, which are far more lucrative than, selling widgets. There's quite a good meme going around at the moment of a few Wall Street bros in sort of their vests manufacturing iPhones. But
it sounds like that's what Howard Lutnick wants them to do, to put the screws in the iPhone factory, although that will much more likely be in India than the United States.
Yeah. But I guess, we're going to move on to what does this mean in terms of your advisory work to funds, to trading houses, to governments themselves. But I guess the through line here is that the signal is, listen to Trump. Trump is saying tariffs. He's singularly focused on that. It's unlikely that we're going to see Congress, reassume its power in this capacity to fight this, at least for the next 2 years. And you've got people in the administration who are there pre-selected because they are on board with whatever policy it is, right? So we are going down a world of tariffs on goods. If that starts spilling over into services, it's going to be a very different, global trade war that happens. And I wouldn't be surprised if that starts to enter the conversation. As you say, at the moment it's very sort of one-sided, very much about goods. They're clearly, well, we don't need to go into it, but how they came up with the tariffs was rather interesting. But if that is the signal, and you do have this playbook, you can go back and look exactly what President Trump wants. What does that mean for economic policy over, let's say, the next 2-3 years? Like what is the 80%, the 75%, whatever the signal represents, likelihood that we're going to see?
It's a great question, Paul. I think if you look at the administration's messaging, the ideal shift for them is that the narrative turns to, by April or May, to tax cuts and TCJA permanence. If we look at how Treasury Secretary Bessent defined success, he has this plan for 3 threes: sustained 3% real GDP growth, a fiscal deficit of no more than 3% of GDP, an increase of 3 million barrels per day of oil production. All 3 of those look very difficult to achieve over the course of a 4-year presidential term. Certainly the nowcasts and the Wall Street consensus doesn't get you close to 3% real GDP growth. It's very hard to see a fiscal deficit of no more than 3% when it's currently around 6%, and you're adding what are largely going to be unfunded tax cuts to that. And then if 3 million barrels per day of oil production in a world where the US oil sector is buffeted by tariff uncertainty, rising costs, and President Trump's on stage at Davos asking OPEC to pump more and bring prices down. They're currently below shale break-evens if you trust the Dallas Fed data from last month. It's really hard to see any of those be achieved. But it's also hard to see the tariffs having a significant effect in terms of reshoring manufacturing and reshoring industry. If you're looking at putting a factory in the United States, even if we take the most optimistic assumptions, call it a year to permit, 2 years to stand it up, then you've got your payback period. You don't even know if the Republicans are going to have unified control of Congress in 2 years' time, let alone who will be in office in 2028, and the degree of long-term certainty needed, not to mention the degree of reform on issues like permitting, on environmental laws, and the scale of the energy demand you'd need for this is just unfeasible. So what you probably see is a decrease in investment. Consumption looks scary, especially when you accept that 60% of consumption happens among the wealthiest 10% of Americans, all of whom are nervously checking their brokerage account this week. It doesn't paint a pretty picture. And that is a real problem for Republicans as we get closer to the midterms.
The energy and resources sector is experiencing unprecedented change. To help companies navigate this world and capture its opportunities, HC Group launched Enco Insights in 2023. Enco has rapidly become the leading global expert network dedicated to energy and resources. Enco Insights leverages HC Group's 20 years of connections and dedication to the sector to give clients the expertise they need to take decisions fast. Connect with Enco's experts for anything from a 1-hour insight call to a longer-term consulting project at encoinsights.com.
It's fascinating, right? I mean, sort of living through this right now. So, for example, upstream oil and gas on my son's soccer game last night, an executive lamenting, how they're going to buy particular valves from Canada, talking to their Canadian supplier, and everything's basically on hold. And the reality is, as you say, with a 4-year term, even 8 years, you can't, that MPV calculation is very hard. And probably the answer is you're still better off just paying the tariff, because you're not going to, reshoring here, the expense of workers, all this kind of stuff is going to essentially be prohibitive.
I was just going to say, I feel for the executives who listened to the message of the last two administrations that decoupling and de-risking was a US-China question and put factories in Vietnam or India or Cambodia or Thailand, because in some ways the great political sea change of Trump's first election and his first administration was, by the middle of his term, US-China competition and the absence of a win-win in US-China economic relations was Washington orthodoxy. And the Democrats bought in too. You need only look at, say, how the Biden administration expanded semiconductor export controls. So executives have been hearing for 8+ years that as long as you reshore from China, that'll be okay. And that was the message of both the first Trump administration and the Biden administration in its tax credits under the IRA, and more broadly in its messaging. And now the goalposts have shifted quite significantly.
Yeah, I mean the internal inconsistency on some of this. Okay, fine, we want to cut the deficit, lower the debt, and obviously there's the narrative going around at the moment about it's all about lowering the yield on the 10-year note. Well, if you then push through these tax cuts, which, as you said, were largely unfunded and are huge, you suddenly get a situation where actually all of that reverses, and you really put the US under pressure about its fiscal stability, right? I mean, it's just it seems, that all seems very noisy to me. You've got these policies that we're talking about them as signals, but in the end, a lot of them are internally inconsistent. You can't have economic energy dominance at $50 oil because no one's going to drill in shale, right? I mean, it just seems like there's a lot of sort of contriving to try and make this a coherent suite of policies when actually they're not, is sort of what it feels like.
That's right. The signal is WTI prices rather than drill, baby, drill. And the signal is Trump pressuring the Saudis to drill more and not any kind of significant deregulation. Obviously, deregulation has happened, but as we've seen from both industry comments and industry surveys, executives think the cost of regulatory compliance is a couple dollars a barrel, if that. So the signal in terms of the effect is clearly from the price rather than from any kind of deregulation.
Yeah. Well, let's do that. So let's move on to, we're going to cover energy and then metals, and then we're going to cover some of the security piece, and then move on to kind of the trade opportunities that some of them that you've been highlighting to clients. Okay, so on energy, so crude, it's lower oil prices is the key signal rather than energy dominance. Is that a fair statement?
That is a fair statement, Paul, and you can't square that circle, right? In the US and in US shale is one of the higher cost producers in the world, so lower prices have an outsized impact on American production. The Saudis will make money come what may. They might make significantly less, but the US producers do need higher prices, and that's the signal we've seen from the administration. One question that's we think a little more interesting is the scale to which the tariff issues and the broad global perception of the US as a less reliable partner affects gas markets. We haven't really seen that play out, but if we look at the response in East Asia, in Europe, to these tariffs and the scale of purchases that are likely to ramp up from US LNG producers, I think it's difficult to envision those negotiations being as easy as they would have been, say, 6 months ago, because suddenly the US is no longer a fully reliable partner, even from a European perspective. The trading dependence on Russia for dependence on the United States and your gas markets seemed a very safe one since the invasion of Ukraine in 2022. It's still safer to buy American gas than Russian gas, but it's no longer fully safe in terms of your trade relations and economic relations between the two blocs.
Which is fascinating, right? Because you've got lots of liquefaction plants that have got the permits moving towards FID, all this piece, and they're predicated on essentially long-term contracts underpinning their development. But this uncertainty, all this noise, means that the Europeans are probably incentivized to have shorter contracts. Meanwhile, you've got Qatar ramping up as well. I mean, it could paint quite a bleak picture, not necessarily this year or even next, but in 3 years for the US gas industry.
I think that's right, Paul, although there are obviously huge tailwinds from the shift in European buying patterns, from a surge in domestic gas demand driven by data centers and AI. But what you really have in this world of volatility, geopolitical volatility, decoupling, and inconsistent policy is a premium on optionality. And that just makes it so much more difficult to buy into these long-term contracts, given you don't know the next Truth Social coming out the White House, and you don't know the direction of US policy over the longer term, nor for that matter do you have a clear read on the direction of US or European climate policy. It could well be the case that the long-term LNG offtake you find is inconsistent with climate policies down the line, although I happen to think that's quite unlikely. But broadly, all of these uncertainties as they grow just increase the premium you pay for optionality, and that makes it quite hard to sign the kind of contract that makes a project bankable.
Yeah. Where do we sit? I want to move on to power, but where do we sit on Nord Stream? Well, sanctions coming off Russia, a rapprochement there, that seemed more likely, again, this is very date stamped, that seemed more likely 3 weeks ago than it does today. What do we hear? What do we know? I mean, it would seem to me not in the US's interest to rebuild Nord Stream 2 and allow that gas to flow again, given the opportunity for US LNG.
Yeah, it's most certainly not. But what you're seeing is a significant shift in specifically German attitudes to the Russian relationship. And it's interesting because at the same time as Germany rearms itself, the pressure from German industry, the pressure from the SPD, who have traditionally been closer to Russia, is rising for a restart of some Russian gas flows. You have German industrial leaders coming out and saying quite specifically, we would like to buy Russian gas, pipe gas, not in the kind of quantities that we saw before the war, but to bring our prices down and to make up for some of the supply deficits that exist in the European market. And frankly, it's very difficult to see Germany filling its storage this winter and potentially even next winter if that doesn't happen. But and as the ceasefire has become a real possibility, you've seen that embolden the groups within Europe who'd really like to be buying more Russian gas. It 6 months ago, it looked completely impossible the molecule of gas would ever flow through Nord Stream 2. And today it looks really quite feasible if there's even a temporary ceasefire between Russia and Ukraine. And that's largely driven by the economics of the European gas market, but it points to short memories on the European side.
Yeah. Let's talk, just one comment there. If I think back to November last year, again, out on the soccer field, I should say football, shouldn't I, for our English listeners? But, there was lots of exuberant oil and gas executives, about the election result. It would seem to me the noise at the moment, or the signal even, is that the Trump administration isn't answering the phone to the oil and gas industry when it's phoning up saying the low prices are not good for us. They're not good for US energy dominance. This, like, tariffs aren't. It seems like actually this is a sector that sort of, it's just not in the, at least oil and gas is just not in the sights of the Trump administration right now. Is that a fair comment?
I think it's a fair comment when you look at what they've done, actually. Sure, we've seen some deregulation and rollback of the Biden administration's regulations around methane and other issues. But the Trump administration has brought oil prices down significantly, both on the supply side by pushing for an OPEC deal and on the demand side by creating these immense growth fears in the global economy. They have also cancelled Chevron's license in Venezuela and created quite a bit of uncertainty there. So On net, I think it's fair to say that they've probably been a significant negative for the oil and gas industry, and I think you can see that in the stock prices. You need only look at a chart of the majors' prices this year to see that. It is an about turn from what the administration promised, but rhetoric is cheap, especially cheap when you're not in office. And I think we've seen really the limits of government power to change the fortunes of the American oil industry. That, for me, is the big lesson, that this is a sector that is somewhat more removed from living or dying by regulation than we might have previously thought. And instead, what matters is the global balance.
Yeah, and then you throw in tariffs. So let's just tackle power, and then I think we'll pause it there, and we'll come back in a part 2, because you and I can tell we're only halfway through our notes, and I'm enjoying myself. So power, what was the signal around power, and how does that translate into what we've seen, if anything, from policy support?
The clear signal around power, if we look at the US market, is that the demand growth is being met primarily by gas. Now, we've seen significant announcements around new energy sources, right? We've seen deals with geothermal companies, with small modular reactor companies, with other forms of advanced nuclear. But we haven't actually seen those projects produce electrons at scale, and they probably won't until well into the back half of this decade, or more likely the 2030s. Where the needle can be moved today in response to both deregulation and to the demand growth from artificial intelligence is in nuclear restarts, and there are probably 3 to 4 mega reactors in the United States that can be restarted. Obviously, the economics work today, so we're seeing tech companies snap them up at scale, but those opportunities are probably exhausted. And then it's in gas. Part of the problem for the US gas industry over the last decade has been that in many places and many cases, your resources are stranded from the locations in which you can get the highest price for them. You need only look at how low prices have been in Appalachia or in some of the other key US gas basins, given the constraints on LNG send out and on pipeline construction. What the surge in demand from data centers does is it means you can bring the demand to you rather than getting the gas to the demand. And we see that in the forward CapEx plans of these tech companies. So even if the LNG picture might look shakier than it did 6 months ago, I think this is one of the few sectors that hasn't, and one of the few secular trends that hasn't really been impacted by the Trump administration's changes of policy, which is this new location flexible source of demand is a godsend for the American gas industry and for power producers. It's very difficult to see how policy shifts can change that too.
Yeah, it is all predicated on data centers, and again, they're not immune to this sort of reshoring global security focus that we're seeing, as and when, countries are starting to think about their own data sovereignty, and we see a proliferation of data centers elsewhere in the world and, less utilization of US ones, right? I mean, I know that's kind of a bit far out.
It's possible, Paul. It's possible, but it would take both a significant walk back in the tech companies' climate commitments, given the impossibility of building at scale firm power for data centers with low carbon emissions in, say, East Asia or in Europe, given the tightness of that power market. It would also require a social license in power short geographies for marginal renewables to be gobbled up by private interests, and we don't see that. The best analogy there is probably what we've seen with Bitcoin mining. Bitcoin miners flock to cheap power sources, whether they're low carbon or not. But as the miners scale in a geography, they end up getting kicked out, whether it's in China, whether it's in Scandinavia. And we're seeing the same thing in data centers, right? You have moratoria over the last couple of years in Ireland, in Singapore, and you're seeing similar in Scandinavia and other relatively energy-rich parts of Europe and Asia, because given this pressure for decarbonization in those countries, scaling your power supply and then directing it to private interests is politically impossible. The United States, on the other hand, has
oodles of it.
Has the supply to meet that challenge.
Yeah. And then one final comment, and then we'll pause here. We'll come back with part 2, allow people to get a cup of coffee or some rest, and we'll get through what actually this energy policy means for consumer prices. We'll talk about metals, critical minerals, where the policy is at that today and where the tariff impact is. Talk about this whole security focus, security over affordability, over the environment that we're seeing globally, but particularly what it means in the US and Europe. And then we'll talk about sort of, I guess, the how to navigate and the trade opportunities. But my final comment would be, and I guess we don't need to say too much more on this, is poor wind, right? I think the one all of the above power supply piece that's not going to make it in the Trump administration is wind.
Right, and whoever put that wind farm up near Trump's Scottish estate a few decades back has a lot to answer for with their colleagues in the global wind industry.
Yeah. Okay, well, let's leave it there and we'll come back in part 2. Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.